So here's the question. Which one is better? QYLD, XYLD, as seen here, or, you know what? RYLD. Out of these three, which one is the best? If we come to this page, we can see QYLD is by far the most popular with 3.5 billion in assets under management, and then XYLD has a modest 375 million and RYLD 243 million. So in terms of popularity, QYLD definitely takes the cake, but in this video, I want to take a deeper dive under the hood to see what exactly is different between these ETFs, look at the performance, and make a more educated decision. Alright, so the first topic is to quickly give a groundwork of how these ETFs work because they're all buy right ETFs, aka covered call ETFs. So this is the basics of what that actually looks like. So this is split up into a bullish scenario and a bearish scenario because they operate a little bit differently, and hopefully with both of these it gives you a good understanding what's happening. So this first scenario, you buy XYZ shares at $50. And then you sell XYZ call options for $4 expiring on June 30th, exercisable at 55 bucks. So that's the strike price of the call option. And you're going to notice that the strike price is above the current market price. So then at June 30th, when the call option expires, the stock closes at 60 bucks. The option is exercised because it's above the $55 strike price. So you are paid 55 bucks per share, even though it's trading at 60 bucks. And this makes sense because a call option is really simple at the end of the day. It's just an agreement between two people to buy a specific stock at a specific price at a predetermined time in the future. It's a contract. So looking at this contract from the buyer's perspective, they paid $4 for the right to buy a stock at $55 on June 30th. And it worked out for them because on June 30th, the price was 60 bucks a share. So they got it at a $5 discount and they only paid $4 for that right. Okay, now let's move on to the bearish scenario. So this is the same thing. You buy XYZ shares at 50 bucks a pop. The rest of this is the same. So you sell XYZ call options for $4 expiring on June 30th, exercisable at $55. But the difference here is that on June 30th, the stock closes at $40 per share. And because of that, the option expires worthless. And if you think about it for a second, that makes complete sense because the agreement between two people is that you paid $4 for the right to buy the stock on June 30th for 55 bucks. But it turns out that it's only worth 40 bucks. So you do not exercise the option because that doesn't make any sense. Now, as the writer of this call option, of course, you lost 10 bucks in capital gains because you bought it at 50 and now it's worth only 40. However, you still get to keep the option premium of $4, so that helps to offset the $10 per share that you lost because it went down in value. Okay, so that's the basics of how this all works. Now let's talk about QYLD, XYLD, and RYLD. So this is the basics of what these ETFs do, all three of them. They're all exactly the same. So each of the funds writes index calls to cover 100% of their portfolios with at-the-money strikes. And this is on a monthly time frame. So every month, 100% of the portfolio gets an at-the-money call option. Now, to better understand what all that means, I want to read a few clips from an article that I will leave linked down below. As mentioned, these ETFs work off of an underlying index. In fact, that's the only difference between all three of these ETFs. Index calls are settled in cash. The covering securities cannot be transferred because an index cannot be owned. So the difference here in comparison to the XYZ stock example we just talked about is that you're not actually having your stocks called away, you're just settling the difference with cash payments. So to come back to this one, if the stock rose to 60 bucks a share and the call option was for 55, instead of the ownership of the stock transferring hands when it's exercised, it's just settled with cash. So that's how it's done with indexes. Now this one is about the strike price. So calls written at a strike price equal to the market price of the underlying asset are written at the money, which is what these ETFs do. For a standard covered call, if the asset covered by an at the money call has any gains when the option expires, it is assigned to the call holder. For an index call, the writer of the call settles by paying the intrinsic value of the expired option, which is the difference between the value of the asset at market and the strike price of the call. So it's that that difference. The further out of the money the strike price, the less intrinsic value in the option when it's sold. So the lower the premium received. The other side of that coin is a higher strike price reduces the risk of losing the underlying position, or in the case of these index options, being responsible for cash settlement. When the strike price is set at the money, a call seller does not participate in any gains in the underlying asset. Profit or loss on the option is the difference between the premium received and the change in asset price up to the full premium. So the takeaway here is that because these call options are all at the money, there is a high risk for cash settlements, because if the price appreciates a little bit, it gets called away, but because it's an index, you have to settle it with cash payments. And it leaves zero room for any capital appreciation because 100% of these call options are at the money. And coming over here, we can look at the performance of all three of these funds. So here are the funds XYLD, QYLD, and RYLD. And we can see the inception date right here. The notable thing is RYLD is the newest, coming into existence on April 1st of 2019. And of course, these ETFs are based on an index. So right here, they show the index's total return since the date of inception, and then the fund's total return, which is based off of that same index. And we can see that all three of these ETFs trail behind their index quite significantly. In fact, if we come over here, only XYLD has a positive price change since the date of inception. So considering that, and the fact that XYLD lags its underlying index the least, maybe XYLD is the better choice out of these three. And then of course, here are the visual graphs of what all this looks like. So we have the total return in orange, the price change in purple, and then below it is the total return of the index that it follows. So for QYLD, the total return has been 84.59%. And during that same time, its underlying index has had a total return of 312.4%. So quite a difference. And when you look at just the price performance, all of these ETFs but XYLD are actually negative versus when they started. So that means there's no capital gains, and everything we're looking at here is simply based off of the option premiums and those dividends. So because the options are literally 100% of the ETFs, it's worth taking a moment to get a better understanding of the math behind these premiums and when you make money and when you don't. So the formula for calculating maximum profit is as following. Max profit equals the premium received minus the purchase price of the underlying asset plus the strike price of the short call minus commissions paid. Okay, so now I want to do my own example using that equation. So let's say you buy 100 shares at $50 per share of a stock. That'll equal a $5,000 investment. And then you sell call options on those 100 shares at $7 a pop, equaling $700 in premiums. So you paid $5,000 and then you received $700. So you have a total investment of $4,300. And these are at the money call options, same as with these ETFs. So let's give two scenarios. Let's say the price goes up, and in another scenario where it goes down. If the price of those 100 shares by the end of the term, which with QYLD is a month, if the price is $60, then that means the total value is now $6,000. But unfortunately, you don't participate in any of the capital gains. This was all of your gains, the premiums collected from the call options, which are then paid out to you in the form of dividends. And because this is an index and you don't hold the individual stocks, these are cash settled. And that means you pay the difference between the current value of the asset and the strike price. So in this case, that's a difference of $10 per share. So times 100 equals 1,000. So you pay $1,000, which is a loss, minus the $700 premium you received equals a total loss of $300. Now, quick disclaimer, these numbers are made up, so maybe that's skewing the results, but this is essentially how covered call at the money index ETFs work. Even when the stock price goes up, you do not participate in any of that because you're selling a call option at the money. Now, at the money covered calls do command the highest premium, so maybe my number was a little bit low and that's skewing some of this, but that's essentially how it works. All of your gain and your upside is just by the premiums collected by the at the money covered call. Now in the other example where you have 100 shares, let's say the new price is $40 at expiration. That means they have a total value of $4,000. So in this case, the option would not be exercised, but of course you still get to keep the $700 option premium. So that helps to mitigate your loss, because if you remember, you paid $5,000 for the shares, you collected $700, so you have $4,300 invested, and that's now worth $4,000. So again, you lost money. So there's only a narrow range where you can actually make money with this kind of covered call strategy. And that's why if we come back and look at this, the price change over time has been negative. Now in my next video, I'm actually going to talk about the difference between good covered call ETFs and bad covered call ETFs. And spoiler, these are all bad covered call ETFs. And I'm going to go a lot more in depth in my next video, but that's the end of this. I hope you guys enjoyed and got something out of it. If you did and you're still watching, give the video a like, subscribe to the channel, and I will see you in that next video.